Human economic activity is, at its base level, a chaotic system. It's a constant, unstructured flow of goods, services, and currency, shifting rapidly between individuals. But simply exchanging money for a product does not automatically mean a business is taking place. Instead, a business is a highly specialized taxonomic category. To qualify as a true enterprise, an activity must operate within strict boundary conditions, defined by 8 distinct characteristics. We can construct this entity from the ground up, moving from the baseline transactional mechanics at the core outward to the parameters required for systemic survival in a live market. Establishing these strict boundaries allows us to separate casual economic trades from deliberate functional enterprise design. The first required condition is that the action must be an economic activity. This is the baseline requirement. The work is undertaken specifically to earn money for a livelihood. This excludes any goods purchased or produced strictly for personal use, or activities done for non-monetary satisfaction. The second condition narrows this further. There must be a sale or exchange of goods and services for money's worth. Take a simple toy shop. If the owner sells a toy, it passes the logic gate into business activity. But giving a toy to his child is rejected. The gift fails because there is no monetary return. Without value flowing back, the business definition breaks. The third condition we must look at requires regular dealings. A singular, isolated transaction is a statistical anomaly. It cannot form the foundation of an operation. Selling an old air conditioner to buy a new one is an isolated point, not a business. But continuously buying and selling units validates the activity. This continuous operational frequency, this regular dealing, converts disconnected exchanges into a recognizable entity. Therefore, the foundational layer of any firm demands continuous, monetized exchange intended for livelihood, permanently stripping isolated or personal trades from the model. With the external rules of exchange defined, we can examine the internal mechanical engine of the entity. The fourth condition is the production or purchase of goods and services. A firm requires a systematic conversion mechanism. This can be procuring raw cloth, manufacturing it into shirts, and outputting finished goods. That identical logic applies to intangible services, taking an input need and processing it through banking or transportation infrastructure to deliver a solution. But that engine only runs if it meets the fifth condition, the profit motive. Earning a profit is not a beneficial byproduct of the conversion mechanism. It is the essential fuel required for systemic survival. Look at a property dealer's ledger. They purchase a home for 85 lakh and sell for 95 lakh. The mechanism isolates a 10 lakh delta. The operator's objective is to maximize this revenue delta by increasing sales or minimizing costs. That isolated delta is then routed back to the start of the system, acting as the sole mechanism for operational expansion. Consistent value creation is mathematically useless to the firm unless it generates this strict profit delta to sustain and scale the engine. Now we place that perfectly designed internal engine into a volatile, uncontrollable external environment. Survival here requires the sixth condition, consumer satisfaction. Today's environment is entirely consumer-oriented. The operator has to satisfy the buyer in all respects to maintain the flow of capital, a priority modeled by massive conglomerates like Reliance Industries, which uses its scale specifically to anchor consumer service. But even with a satisfied consumer, we hit the seventh condition, the uncertainty of return. An operator starts with a profit motive, but external variables like political shifts, market conditions, and unpredictable demand guarantee that positive returns are never certain. Sahara Airlines launched into the Indian aviation market with a massive boom, recording consistent profits year over year in its initial era. However, due to structural errors and unrealistic programs, that boom reversed. Compounding external variables triggered heavy losses, forcing the airline to wind up operations entirely. This uncertainty is driven by the eighth and final condition, the risk element. Every business activity carries unavoidable vectors of risk, ranging from physical threats like fire and theft to fierce market competition and rapid changes in consumer fashion and technology. Nokia dominated the global telecommunications market by perfecting the physical keypad mobile phone. But their hardware dominance became an existential vulnerability the moment Apple introduced the touchscreen interface to the market in 2007, radically shifting the technological baseline. Surviving that level of technological risk demands immediate adaptation to new standards, forcing competitors to pivot to similar interfaces just to survive the new market conditions. Long-term enterprise survival depends completely on balancing strict internal profit mechanics against these volatile, uncontrollable external risks. A business, then, is an economic engine utilizing continuous exchange and production to generate profit, encased in a consumer-focused buffer designed to absorb and survive environmental risks. These 8 characteristics are strictly codependent. If you remove even a single parameter, whether you eliminate the regularity of the dealing, extract the profit motive, or ignore consumer orientation, the system collapses, instantly downgrading the activity back to a mere transaction. Mastering these 8 strict boundaries provides the precise fundamental DNA required to analyze, build, or deconstruct any enterprise on Earth.